Yeah.
All
Okay.
right,
Cool.
awesome, Brian. Okay, so just put this up. All right, so like I was saying, I'm gonna bring this up. And yeah, I have not been using the RSI. I have not been using the pillars. I'm just going to show you guys naked chart trading, and you can implement this as soon as we, I'm at work, not trying to interrupt. Let me see. No, it's cool, bro. It's cool. As long as you can hear, Brian, it's cool. So, like I was saying, I'm just going to show you guys naked trading. And this method that I'm going to show you guys is basically the whole nutshell of the trading. All right, so the first thing we got to understand is marking up our chart. So I'm going to open up a new chart. I'm going to go to Euro USD because Euro USD is the most common pair. It has the smallest spread. And Sean, you probably don't know much about spreads and things like that because you're new. But spread is basically when you enter a trade, if the spread is small, you're going to enter at that closest towards where the price point is when you actually initiate it or click that buy or sell button. When the spread is wider, sometimes spreads go up to 10, sometimes 50. So basically what that means, the wider the spread, the farther away you're going to be from where the price point actually is, if that makes sense. Sure.
Yeah.
Yeah? All right, so I'm going to explain it more. So if you got a question? Question? All right. Okay, I'm going to click Euro USD. I'm going to bring this up. Now, of course, the first thing that we want to do, we want to go to properties. Let me just, matter of fact, I think I got my template. Load template. All right, so it brought up all my stuff. I don't want to do it that way. I want to draw it out with you guys so you guys can see exactly what I'm looking for, what to look for. Because once you really get the hang of what to look for, I mean, you're set. Everything else from there is just easy money. Trust me. Okay, so let me just do this white and black. Keep that gray bar up. Let's make that a dark. I want to show you guys this from scratch. You can see exactly what I do when I'm coming towards a currency pair, like how to look at these pairs to know when to get in, when to take the right trade. So the first thing that we want to do when we open up a chart, the very first thing that you want to do is look for major support and resistance levels. Very important. There's traders now that make thousands, hundreds of thousands of dollars trading support and resistance levels. Just this, what I'm about to show you guys. So how do we go about finding support and resistance levels? We have these candlesticks. We already have our candlesticks. The first thing that we want to look for is when looking for support and resistance levels, you're looking for consistencies in the candlestick. Areas where you see the market coming up to or coming down to and actually pulling back. And in most situations, it's a very fast pullback. So let me just give you guys one that I already see, and I'm going to show you guys exactly how this works. So I'm going to start off with this wick right here. You guys see this candle? I want you guys to really let me show you guys where I'm actually going to start looking at my line at. You see, can't really see it from back there. That's way too far back. All right, so I'm going to start right. Grab this. Okay, so this right here looks like consistency, right? If I were to put this line here, this is what I mean when I talk about look to the left, structure leaves clues. I wouldn't even put it right here. I'd probably pull it up like right here. This right here would probably be perfect because look, we have, now remind you, each candlestick is 1 day. So you always make sure that you guys understand that you always have to be in the 1 day chart, 1 day or 4 hours. But I like to go on the 1 day chart because you get really strong support levels. The better of a support level you get, when the market comes up to that level, you're going to take that sell. When the market comes down, you're taking that buy, you're placing your stop losses, you're walking away from the charts for about 8 hours because it takes time for the market to move. That's the only way to really make money. Like you can do a 5-cent trade, and if you sat there and you let it ride for about 200 pips from a 5-cent trade, can easily turn into $100. It's really not about the volume. Of course, volume is always a good thing. Let me just bring this down. Volume is always a good thing when you're doing, one lot trades, two lot trades. Of course, you're going to make a lot more money, but that's not the goal. The goal is to be right more than you're wrong. If you're sticking to a consistent trade volume, then if you're right more than you're wrong, at the end of the day, you're going to have more money in your account. A lot of people lose because they get greedy. You don't want to get greedy. You want to trade. I would say whatever you have in your account, you want to trade 10%, 10 to 15% trade volume. So what that means is if you have $100 in your account, the highest trade that you should be doing is a 15-cent trade. Now, when you initiate that trade, it's going to look like, oh, you're not going to make much money. But once again, it's all about being right. If the market continues to go in that direction, the more pips you make, you're going to make a lot more money. So if you catch 100 pips with a 0.15 a trade volume, you can make $150. And you continue to keep building and building. And in a month, your $100 can be well over 1,000, well over 2,000. Easy. Okay, so let's go back to this. So what I'm doing right here, the reason why I'm drawing this line is because we see consistency. Okay, the first thing that we see on these one-day candles, we see this push down, right? You guys see this candle right here?
Yeah.
This candle right here. We have a push down. It pushes into this price level. Now, history is the only way we can understand what these guys are going to do. It's the only way. That's why we draw these lines. Okay, so we get this push down to this price point, quickly reverses. Okay, now as I go across this line, do you guys see the consistencies? Do you guys see right here how the market came up, instantly push right back down, came up again, instantly push right back down off that price level? Okay, look at all these pins and all these wicks coming up to this line, and boom, just drops. Okay, that right there is called support. When the market is below the lines, it's support. When the market is above the lines, it's resistance. So right now, this was support. The market kept coming up like a wall. You got to look at these lines like a wall. So when you're drawing them, you just have to look for that connectivity of the candlesticks and the price points. So let me give you guys another one. Market comes back up to this level. Look, right there. Boom, drops again. These are the trades that I want you guys to consistently wait for, right? Because it's a waiting game when it comes to support and resistance. But I'm telling you guys, if you just trade support and resistance, you're going to win a lot more than you're losing because history repeats itself. I don't know what it is about them coming to specific price points, but I just know it happens so often. You're going to see it. Okay, here's another example. Market pushes up to this level, doesn't even come close to it, reverses back down. Now, these are huge moves, guys. I'm going to pull out my crosshair right here, and this is how we count pips. You know, you might think this move right here was small, but look, this move was 300 pips. 300 pips, guys. That's a lot of movement, okay? And as you can see, more consistency. Market coming up to this level, comes back up, drops a shooting star candle, drops right back down. So I hope you guys are starting to really get the hang of what's going on here. So when the market is coming up to these support and resistance levels, or these lines that we draw that are basically giving us an indication of market structure, of what has happened before, okay? Because basically what's going to happen is this line is going to run all the way through. It's going to run all the way through, and we're going to consistently get pushes up to this level. We've been getting pushes up to this level for months now. Months of action, months of accurate trades, okay? So let's keep going. Let's keep drawing some more lines. Now remember, it's all about finding that consistency. The better you are at it, the more money you'll make. It's just that simple. Okay, so I'm gonna probably put one right here. Matter of fact, I mean, I can put one right here, but I feel like this right here would be a better spot. And I'm gonna show you guys why. And I'm pretty sure you're already seeing it. Okay, the market pushes down to this price point. Remember, all that's going to work, forget the indicators, forget all that other stuff. All that really works to me in my 3 years of trading is the market history, what they've done in the past. It works like a charm. So look, we get a push down right into this price point. What it does, reverses. When things like that happen, that's telling you that at that level, that price level is a strong level for either the buyer, and in most cases, when these levels are broken, you're going to get a huge breakout candle. Mostly all the time it happens. They have to really push through that price point. All right, you got to understand, it's movers and shakers. There's real people that are controlling this market, and they do the same thing repetitively, again and again. So after we go through support and resistance, we're going to talk more about patterns. Okay, so let's draw a couple more. What about right here? How you guys feel about this? Do you guys feel like this right here would be a good level to actually draw this line?
Yeah, that was my question. I don't know if do you take questions during the call, or how do you do that?
Yeah, go ahead.
Yeah, because my question is like, right, we just drew that line right now, right? Before you had drew that, I was like, okay, well, it broke that one, but it stayed down there for a while. You know what I mean? So like that first dip right there, it took a minute for it to come back up, and it took a while for it took that M, that W right there before it even went back to those initial lines that you had. So I guess my question is how do you find that money again? Because that's why you're drawing that second line, because there's actually two different levels of where it's doing that, breaking those barriers.
Well, yeah, that's why we're going to draw more lines. I mean, there's more lines here, but at the end of the day, I see what you're saying when you say that it took a while to come back up here, but
right,
it's all consistency. Like, this is the one-day chart, so I'm pretty sure right here in this area right here, it will be consolidation. So that's more validation that this right here is a strong price level. Around this price level is a strong price level. We also get more confirmation because it's really not about. It's just really about seeing the structure. Because look, if you look at this is structure. Look, you get a push to this price level, reversal. Push down to this price level, reversal. W pattern right on this price level. You get more consistency. You get a push up to the price level where it then becomes resistance. Pushes down. You get a breakthrough candle. Remember what I said about breakthrough candles to push through these levels. As you can see, more consistency. Push down into this level, reversal, breaks through the level, which happens. You got to understand, it's not perfect. It's an 85% success rate, which is very high, but it will never be perfect because we really can't never predict what they're going to do. So look, this time they drive it down more. Why do they do that? To trap traders, get people to think that it's going to keep going down, and then what they do, snatch it right back. Because they know that we look at history. They know that. That's why sometimes you're going to get moves like this. Here's another move. Look at this. They break, completely destroy this support level. You have a breakout candle, and then look, boom, drops right back down. So you're going to get situations where it does actually break the level, but then you're going to get something like, here's another one. And remember, these are one-day candles. I'm gonna go. Matter of fact, I'm gonna go down into a smaller time frame. But matter of fact, let's do that right now, and let's see what we're looking at on a smaller time frame. Wait, I think I did not mean to do that. See, the smaller time frames just make everything just be everywhere. It's harder to really see what you're doing.
Right.
All right. So let's draw a couple more lines. Like this right here would be another level, and this move right here, based off of, you see right here, this was basically a W pattern. You get two pushes down, boom, and then you get another one and it pushes up. So that right there is the first level of structure created. Then look, months later, it comes right back down to this level. We took this trade.
Yeah.
When this happened, we took this trade. We made so much money because it runs away from these support levels. Here's another one. I'm going to show you guys what just happened the other day and why it happened. Okay? Another one. Market. All of these trades were easy trades just based off of these lines that I drew. As you go into smaller time frames, let me see if I can get this so we can see it better. All right, so market comes down to this level. Remember? Support, right? Oh, no, sorry, resistance. I mean, you can call it whatever you want. At the end of the day, they're all just walls. You just look at them as walls. Market comes down to this level, doesn't even break it. Comes down to this price level. We don't know the exact price number of that price level, but it's in that area. That's all we really need to know. In this area is some type of price based off of previous structure. You guys following?
Yeah, now I'm getting it. Yeah.
Awesome. Yeah, Brian. 2K. And I'm going to show you guys why. Because we're going to get more into it because it's not just about support. It's also about trend lines. It's also about flag patterns. We're going to get into it. But all right, so market pushes down, creates a W pattern, easy trade. You guys probably could have took this if once you really start looking at the market and you start understanding these support levels and drawing them. You guys would have took this trade. I mean, it bounces. It comes down to the blue line. Remember, which is a price barrier. Just look at them as price barriers. I just want to make it as simple as possible. All right, and look what it does this time. And this was just like a beautiful move, beautiful trap move. Pushes down. Look at this, Henry. Boom. Pushes down. Tries to get, and it tried so hard to get, like me and every other smart trader, to think that it was going to keep going down. But look, as long as we have our support lines, we know what's going to happen, right? You see the blue line right here?
Yeah.
That's the support line based off of previous structure. Look, if we go back to the past, look at all these moves. Pushes to this level, bounces up, pushes to this level, bounces up, breaks the level. Remember what I said about sometimes they're going to try to push it a little bit more to try to get more money, to try to get more people to think it's going to run away. Brings it right back up, pushes down, bounces up, pushes down, bounces up, pushes down, bounces up. Every time it did that, I made money. It's just really that simple with support lines. But you just really got to be good at it because that's the only mistake you can make when it comes to drawing support and resistance is not putting in enough time to really find those levels. Because just like Henry said, Henry saw a level, and I saw a different level, right? When you're putting the lines in the wrong area, then you might take that trade and be like, oh, it came to this price barrier, and that was actually not the area where it should be. So you guys really got to get good at that. Once you hop into that 1-day chart and you just throw the lines up, boom, 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 find the structures, then jump into the 4-hour chart. Like, take your time. That's something that I always do. I take my time when I'm drawing my support lines, when I'm finding my Fibonacci retracement, all that stuff. All right, so let's go back to this. Do you place the line using? Hold on, let me read this. Do you place the line using the wick or body? That's a good question. Sometimes it's the wick, bro. Sometimes it's the wick, and sometimes it's the body. But it's really just about. Let me give you another example, Brian, because I really want you guys to understand. Like, when you're in the one day time frame, you want to account for everything. The wicks, everything. Like this right here could be a level where it pushes all the way up here. It pushed right into previous structure. We have consolidation right here. If we put this line right here, look, structure. Look to the left, structure leaves clues. So, and look, I did that off the wick, Brian. That was right off this wick, okay, because that was the last high created back then. Okay, so, if the market did push up here, if you had this line drawn based off of previous structure, you could have put it here, probably could have put it right, you could have put it here. Anywhere that you would have put that, you would have been able to take that trade and you would have came into some serious profit. You would have been able to get out whenever you wanted to get out. So it's really about, I don't know, I hope that answered your question. Henry, do you have any questions or? Okay. Nobody else have any questions before I continue?
I think my main thing is just when you're drawing these first resistance lines, you want to start on a day one chart. That's the biggest thing for this one right here, right? And then my thing also is when you make these lines, does it automatically save this stuff?
Yeah, it automatically saves it. As soon as you make the line, it automatically saves it. It's always going to be there for the future. So like right now, we're probably going to have a good day coming up. The market's pushing up to this level. So when it comes up to this line, all you got to do is just sell it. That's all. Sell it. Make sure that you don't use a high volume that's going to, because like I said, sometimes they'll push it more. They do that all the time because. Somebody else following me. they do that because they're trying to trap people. They're trying to get them to go the wrong way. All right, so let's go back to this. Perfect pattern is, they push the market down, comes to this level. That's all you're doing. When it comes to these levels, all you're doing is just trading it the opposite way. And it's not going to come to these levels a lot. It's not like it's always, see, the thing about it is that you don't want to be having too many things on your chart to where now you're taking trades that probably aren't even there. Now you're basically looking for things that aren't even there. This right here is valid because this is the history of the market. And that's the best things to go off of is the history of the market. Now, let's talk about, do we have our lines? Yeah. Okay, so basically this chart is marked up. Matter of fact, let's go to a different chart. I'm going to go to a totally different chart because, honestly, Euro USD is like the easiest chart to mark up. Let's go to one of these more complicated pairs. As you can see, this pair is crazy. All right, let me just do this real quick.
And then can you give me clarity on the pips when you get a chance, Lamarvin? Just to get that's the only thing I'm not clear on is the pips. Like, how do you calculate that?
Cool. Let's go back to this. Good question. Let's go back to this chart. All right, so pips. Calculating pips, the best way to do it is on a laptop because all you have to do is go to this crosshair. See it right here? You click that. Now, pips is basically per price movement, either up or down, right? So let's say if I call the trade right now, I'm going to call a trade. Boom. Call a trade real quick. Okay? I call one, I call two trades. Okay, now those trades are active. You see the trades right here? Go for myself.
No. Okay.
You see them? Okay, now you can either count pips this way, and counting pips is very important. Very, very important. So that's really a good question. Because for example, right now, I feel like this is what's going to happen in the market. The market's going to drop down to this level, and it's going to bounce up and keep going up. So let's say if I wanted to get out at the right time, because the market could come down here, and I could come into profit now, and then it could just, basically just run away, and I can go straight into the negative. So the best way to handle that is just to count your pips. So say if I want to catch, I only want about 30 pips. $1 trade, if I catch 30 pips, I make $300. As you can see, as I hover over my trade and I start to scroll down, you can see it's giving me how much money I'll make. You see it? It's a TP,
yep.
200, and it say the pip amount. And you see it say 248 pips?
Right,
Okay, so basically the last number doesn't exist. Just don't even think about the 8. It's really 24 pips. So that's how many pips I would catch, right? Pips meaning movement in that direction. So when you do a sell, you're hoping it goes down. And as it goes down per pip, you're going to make $1, then it's going to times $2, then it's going to times $3, and it's just going to start going up really fast. All right, so let's say I want to catch 30 pips. 30 pips would be $300, and it would be probably like right here, if that answers your question.
Right, okay. It gives me just a little bit more clarity. I just need to know how to count those because, like you were saying earlier, we just need to get consistently at grabbing 20 pips.
Yeah, well, look, that's all you got to do. Be on your laptop and just scroll this, like hover this around, or you can look at this. Let's say if we count how many pips this move from here to here was, right? All we got to do is grab our crosshair and pull it up. As you can see, the middle number is the only number that you want to worry about. Don't worry about all the other numbers. It's just going to confuse you. Don't even look at those numbers. The middle number of 1,807, right?
Right.
Remember, the last number doesn't exist. So how many pips is that?
180.
180 pips. That was 180 pip buy move. That's how you count pips. Let's look at it again. Let's see this move right here where the market basically retraced off of the high. Let's see how many pips this would have been from that red candle to the last red candle before the green candle. Take it down. Okay? Now remember, the last number doesn't exist. How many pips is that?
34 pips.
34 pips. That's it, bro. That's really all it is to count pips. Now, like I said, when it comes to the trade volume is a little bit more complicated, but it just really takes you downloading MetaTrader 4 and just start taking trades on a demo account. Like, that's the best way to really explain trade volume. But it's really as you go up in your trade. Let me put the terminal up. Let me go to my trades so you can see the trades. See the trades are active. Now, you see, I'm already in the negative. The reason why I'm in the negative, you always start off in the negative because of your spread. All brokers have a spread, so you're always going to start off in the negative. Now, the higher your trade volume is, the more of the negative you're going to start off in. So let's say if I do a $5 trade, which is a very high lot size. You see how I start negative 25?
Mhm.
As it starts to go down, I come into profit. You see the trade starting to come into profit?
Right.
So, yeah, you know, I hope that right there answers your question a little bit more.
Yeah. And my only thing, too, is how did you grab that crosshair? There's a lot of tools in here. I'll figure out those tools. But is that just, how do you grab that?
Right here.
Crosshair.
You see where I'm at?
Oh, okay, yep.
Got it. So all you do is grab it, and let's say you want to count this move. Because, you know, pip amount means a lot. Like, for example, let me give you an example, right? Market moves 200 pips, right? This is like 200 pips, right? This move from here to here, where they counted it. When the market moves in a direction like that for so long, always have it in the back of your mind that the market cannot move in one way just continuously. It never does that. It will retrace. It always retraces. Just like after this move, they started to retrace. But as you can see, this low right here was never broken. It was never broken, so that makes the buy still valid. And you probably don't know what I'm talking about right now, but as you go more into the trading, you're going to understand it, especially when you go over the webinars. But, all right, so let's get into something else, right? So that's basically how I come at the market. The first thing that I'm looking for is I'm waiting for support and resistance levels to get hit. If you just wait for trades like that, you can make money just doing that. That's all you'll really need. But let's get down into more technical type of trading. All right, so the next thing that I like to use is the Fibonacci. Now, how to use the Fibonacci theory? Well, the Fibonacci retracement is simple, all right? If the market's going up, this is what we're doing. You come right here, draw Fibonacci retracement, put that, and all you're doing is just basically drawing from one end, from swing low to swing high. So what we're going to do is we're going to take it from the last low created. I grabbed it the wrong way, and we're going to take it to the high. Now, basically, how the Fibonacci retracement works is when it comes to, I wouldn't even say the 38. The 38.2 is right here. I don't know if you guys can see that. It's pretty. Let me just change it. And this is another way how I take trades, because that's what we're really looking to do. When to get into a trade and when to get out. Okay, so I'm going to make this red so you guys can see that. All right, so the 38.2. Now, how the theory works is when the market comes down to the 38.2, it's going to reverse and go back up. But I don't really like trading off 38.2 because a lot of times the market breaks that level. What I like to do is I wait for it to come down to the 61.8. And as you guys can see, we have that consistency. Look, there's a price barrier right here, and it lines almost perfectly with the 68.1. You guys see that? Now, that's what I call consistency right there. That is a perfect condition. So if the market ever came back down, which it will come back down and test this level before heading up. All you're doing is waiting for it to come down there. Maybe you hop on while it's around this area. What are you looking to do? Buy or sell?
If it's coming down to it, well, if it's there, you're wanting to sell or buy right there if it's going up, right?
So if the market comes down to this price barrier, what are you looking to do?
You want
buy.
Yeah.
Buy, right?
Yeah, buy. Yeah.
Exactly, but why? Why would you buy?
Because it's going to go back up.
Exactly, because of the price barrier, and also using the Fibonacci theory. Remember, drawing our extension from swing low to swing high. Basically, how you're going to use the Fibonacci is the last major push, right? The last major push. So let's say if we got into the market when it was right here at this area. what we'd do is we'd take our Fibonacci and we'd take it from the last low into the last major push. And then from there, what we're looking for is one thing, the 68.1. All right, we're looking for, maybe it might come down there. Now, this right here puts you in two good situations. So since we know that the market might come down and retrace this level, right, and come down here and then head up, right, push down before heading up. Bro, you mad loud? Yeah, you mad loud. But so this right here can give us an indication to sell, right? Market could come down here. You can probably just sell it, probably about 20 pips. As you can see, I already have my trades in. Always put our stop losses. Show you guys. Let me take these trades out real quick. This is always what you want to do. Because right now, I really don't even see. Right now, there's no trades available on this currency pair. It's not next to no. It's basically sitting up there in space. I definitely feel it's going to keep going up, but not before it hits this support level. So I'm not really going to call no trades, but I'm just going to put in a trade. All right. Every time you put in a trade, you always want to have your stop losses. Now, where do you put your stop losses? In most cases, you want to look to the left. You want to look to the left. To the left, you find the last high made. Sorry. And what you want to do is you want to hover over your. Oh, I know, right? Hold on. What, you got it? All right. You want to hover over your trade, and you want to just pull. In most cases, I don't really like. You see how much of the negative I would be with this trade? Negative 1,275. Because this is a really large lot size, and that's only about 30 pips. Me, I like to make my stop losses very short. So, you can I like to put my stop loss real short. It all really depends. Like, when the market comes down towards these levels, I put my stop loss be really tight. Like, it'd be like right here. So if the market does go in the opposite direction, I just get stopped out and I won't lose as much money as if I kept it open and the market just kept going in the wrong direction, if that makes sense.
Yeah, how do you set those up again, that stop loss?
All you're doing is just hovering over your trade.
Your trade, okay.
Yeah, and just dragging. You see the red line?
Oh, okay, yeah,
Well, that's stuff that you'll learn in the training as well. Hold on, let me see. I think I just transaction. Yeah. Brian, it's the same way. If you're drawing on an uptrend, all you're doing is taking it from the last swing high to swing low, or the last swing low to swing high, which basically means the last low before that extended push up, right? Before that extended push up. That's all you're doing. And then what you're looking for, and this is what I like to do, so I don't have, all these numbers and stuff, I would do this. And this is just opportunity for a trade. I would come here, I would draw a box, that box right there. That right there represents my 38.2 retracement level. So what that meant is, if the market came down to this level, I would take a buy, right? I would take a buy. The market already made a huge push. It broke the last high. This was the last high created. It already broke this level. That's why you always got to look to the left. It already broke the last high. So after it broke the last high, what I'm looking for now is just retracement before that continuation up. So a lot of people would get into the trade too early, which happens a lot. And that's why you want to wait for these conditions to be met. So I would take that. That would be one area where I probably would have got back in on that trade. Here's the other level, the 61.8. Then you could just remove this, and now you got these two bars in which the market comes down, you can just buy it up. Vice versa, if the market was going down. Sorry. All right, so let's talk about a different type of support and resistance, which is trend lines. You guys have any questions?
Not right now. This is all It's all good stuff.
All right, cool. Hold on, Brian. Let me see your question. Yeah, that's what I just said. The 38.2 and the 68.1 are retracement levels. I really just want you guys to trade support and resistance. Like, to be honest, that's all I trade. I trade support and resistance. I do trade the Fibonacci theory because it's when I already know the direction of the trend. If I already know it's going up, I'm just waiting for a retracement because they never just keep going up. They got to retrace. They might retrace back into previous structure before heading up. They might retrace back into the 38.2 before heading up, the 61.8 before heading up. But in most cases, they're always going to retrace. Same thing, vice versa. If they're heading down, they're going to probably come back up, hit a major structure, and then boom, drop back down. If the market is in a downtrend, you're looking for sells. You don't want to be trying to buy if the market is in a downtrend. Like with Euro USD right now, the market is obviously in the uptrend. It's been going up. It's been going up. It's been going up. You know, not saying that there are not sell opportunities, because there's definitely sell opportunities that come in. But if you're in an area, if you're taking a sell in a situation where the market has been rising, I mean, you don't want to stay in that trade for too long. You want to have a stop loss of 20 pips. Catch 20 pips. Close that trade out. The money's in your account. So let's look at this one, and let's start to figure this out, right? Because everything you gotta look at these charts like a puzzle. And this is a very oh man, JBP is always like the craziest. JBP really consists of, like, to me, JBP has a lot of trend lines. Like, look, this is a trend line right here. And trend lines are just like support and resistance lines. You're just drawing a line through previous structure, right? That's all you're really doing is just drawing a line through previous structure. So I'll probably take it like right here. Trend line. Here's another trend line. Another trend line right here. Like I said, this takes time, guys. This isn't something that I'm just showing you guys, but it takes time. It takes time to really start seeing these levels, seeing these lines, seeing these structures. But trust me, you guys are going to get there. I'm not going to say it's like the hardest thing in the world, because it's definitely not. So let's see. Right now, I'm just drawing a couple levels that I see. Probably come to about, I would say, right here, this would be a good level. We have a push down to this price barrier. Have a W pattern, pushes down, reverses. Right? We get a breakout candle. This breakout candle right here breaks through. We have another breakout candle breaks through. And then we have wicks that keep trying to break this price barrier but cannot, and then it reverses. So once again, that's enough. That right there is enough confirmation for me to actually draw that line and put that line there and be like, okay, if the market comes up to that line, I'm going to trade it the opposite way. So that's one line. And, I could start drawing lines all up here. I see a lot of structure, but the market's not up here right now. The market's down here. So that's why we want to focus on that. So let's go into the 4-hour chart. Because like I said, sometimes you could be in the day chart and you can see everything clear. Sometimes you got to hop down into the 4-hour chart, but never draw support and resistance levels on the 1-hour chart, on the 30-minute chart, the 15-minute chart. Never draw trend lines on those charts. They're going to be invalid. You're going to take that trade thinking that it's going to hold, and what's going to happen is you're just going to get destroyed because, it wasn't a strong enough support level. This is going back. This is the 1-day chart. So this is going back like months. Like, this move right here was way back in April of 2015. And look, this same price barrier is still holding way up here in February 2016. Okay, guys? So like I said, these support levels, understanding support levels, understanding trend lines. And I'm going to do, I'm putting up a new page in the training for trend lines, candlesticks, and more about trade volume. I haven't even finished it yet, but I should have it up by the end of the week. So that's going to be real good for you guys to understand trend lines. As you guys, I mean, it's about to be a lot of good trades coming down because how many levels of support? Let me see. Many as you want, as many as there are. I mean, just like, there is no specific number. Like, don't get too caught up in things that really don't matter. A lot of people do that, like, because, I don't know, it's like, find as many lines as you can. There is no specific number, like, oh, you can only find 4 trend lines. No, as many trend lines as you can find that are closest to the market. So right now we got about 4 levels. This right here could be another level too. Now that I'm looking at it, this right here could be another level too. Market pushes down. We got a lot of consistency, and this last move that happened actually happened around that level. Oh yeah. So just make sure that you guys are drawing the support levels, and in most cases trading off of support levels. Indicators don't work. They just they're just basically going off of past history. But your eye is better than the indicator. Trust me, your eye is way better than the indicator. You just gotta want to put in the time to want to mark the charts up and really just get that going. And once you have a chart marked up, all you're doing is just sitting there waiting for things to happen, waiting for it to come next to a price barrier, which are the lines, waiting for it to come next to a strong trend line, which are these diagonal lines. You see these lines right here as they connect with the price action as it starts to dip down. It bounces in between them, right? So as you guys can see right here, look, consistency. You have a trend line here, which in most cases you're supposed to trade the opposite way when it comes next to that trend line. It has to be a one-day trend line. I want to keep saying that again and again, because if you draw a trend line in like the 15-minute chart and you think that it's going to hold, I mean, you're kidding yourself, because it's just not enough structure. I mean, you just didn't get enough structure to actually make that a valid trend line. So we have the trend line crossing with the price barrier. Once again, that right there is a good trade. That right there is a good sell to take. All right, 2 things lining up. That's always a good thing. And I'm pretty sure if I put the pillars, which are still good, the pillars are still good, I'm pretty sure somewhere down the line it's going to line up with that price barrier and those trend lines as well. Let's see. Go to the 4-hour chart. And as you guys can see, both of the pillars, it already broke the pillars. That's why I don't keep them pillars up there, because a lot of times they get broke and you end up getting into trades, and then, like, it just does some crazy stuff like this. It straight breaks the red pillar. That's why I don't use any type of indicators, because it's just based off of the past, and the human eye is way better than the computer. It's just, I don't know. Just make sure that you guys draw your lines. Make sure that you guys are trying to just stay away from indicators, because they're going to get you in more trouble. You're going to be losing more than you're winning. Let's find a couple more. And guys, I'm telling you, this may seem simple, but this is all I do. I just sit here, I draw out my lines, and I just wait for the market to come to these levels, and I'm just trading off of these levels. That's all you got to do. And another important thing is knowing when to trade. Wednesday to Friday, I would say from 6 a.m., not even 6 a.m., 8 a.m. to about 3 p.m. From Wednesday to Friday, from 8 a.m. to 3 p.m. are the best time to trade. London session, I've seen that London session has become the trap trader session. I see a lot of moves. You'll get like 20 pip moves that look like, it's about to be a 100 pip move, and then they just reverse and just start going back and forth again in London session. The reason why you want to trade from 8 a.m. to 3 p.m. is because that's when how you doing? That's when the London session and the New York session, they basically cross over, because the London session is from 3 a.m. to 12 p.m. and the New York session is from 8 a.m. to 5 p.m. So from that 8 a.m. to that 12 p.m., the market is just going crazy. A lot of movements happening. A lot of support levels are being hit and bounced off of. A lot of opportunity for trades. All right. Anybody have any questions?
What vision?
Division.
Oh, your trade division. Okay, I don't know. When did you get the vision? I got Xbox 20. Now you going off now.